This is the Wealth Standard Radio, your gold standard in everything financial.
Hi, everyone. Welcome to the Wealth Standard Radio. This is episode 160. My name is Patrick Donohoe, and I am joined here by the, by now, infamous Will from the Streets. Right? Is that the name?
I think so.
Will of the Streets.
We talked about a rapper name for me last time, and I think that's what it was.
It's codified. That's what we'll put on your bio.
Okay, that sounds good.
All right, we have a cool topic to talk about today, and Will Streets here to discuss it with me. And it's going to be the auto industry. It's a huge market, and it's affecting, I think, two parts of the economy, both from the credit standpoint, the investment standpoint, as well as the actual individual street level person, right?
Right.
Okay, so that's what we're gonna talk about. Should be interesting. There's a lot of things to kind of scratch your head about.
Yeah.
Right. And I think everybody has had, to one degree or another, some sort of bad automobile loan purchase experience, right?
Yeah.
And so I've had my share. And you're in the market right now. Dude, so this is going to be huge for you.
I'm kicking the tires a little bit, literally, on some cars these days.
So yeah, we're actually in the process of writing an ebook, and the ebook is going to be a guide to make money off of buying cars. Because right now, from some of our initial research, the average individual loses up to $10,000 per car.
Jeez,
when you factor in interest, you factor in the difference between dealer price and MSRP, and when you also factor in other things that are thrown there, plus the inefficiency of the process. Because a lot of people they'll spend time doing this and this and this and this. So we are basically writing an ebook. So Bill Fogergren, who is our kind of auto expert because he was in the industry for a number of years. Him and I are going to kind of go through and we're going to write it. So it's going to have a guide, it's going to have a calculator, and hopefully it will help people to make money on cars as opposed to getting fleeced.
That'll be huge.
Right. So we'll talk about some of the topics today. That's cool.
Cool.
All right. So let's go ahead and do this. So first I want to kind of create context with the first part of this topic, which is investment, right? So The Big Short. Right, you read the book.
Read the book. Yeah.
Okay. So, what's The Big Short about? Like, what's the main theme of Lewis's, of why he wrote the book, why the movie came out? Because it's still a super popular movie.
Popular, yeah.
Right, but I'm still like, it was even hard for me to really understand, even at the foundational level, like what went on.
Yeah, what happened.
So maybe you kind of give an overview of that. We've had a couple podcasts in the past. Andy Tanner and I did a few of them, and we really talked about that to a degree. So you can go back and listen to previous podcasts if you want more of an in-depth view or perspective or information about this movie. But yeah, why don't you kind of give Michael Lewis's kind of snapshot?
Yeah. So I mean, essentially, it was the subprime loan industry, right? It was loans being made to
mortgages, right?
Mortgages, mortgages specifically, yeah. So single family homes, loans being made, and subprime. What that obviously means is subprime meaning a less than stellar individual in terms of their credit, their income, et cetera. And so they're qualifying people for these mortgages. And then what they do essentially is they bundle those mortgages and they sell them off, right? And so these big investment firms are buying up these bundled kind of chunks of subprime loans. Only instead of full disclosure to investors, with respect to what those loans were like in terms of their subprime status, you have crediting agencies rating them, giving them fantastic credit ratings, and they had no business giving them those ratings. And so these massive investment firms buying up just these massive chunks of mortgages, just in massive amounts at a time, and the American public having no clue what was
going on.
Yeah, and owning mutual funds and those types of things that are comprised of in varying degrees portions of these subprime loans. Yeah. And then pretty soon, of course, the chickens start to come home to roost, where people, shockingly, the guy who makes $20,000 a year but who is qualified for a $500,000 home loan, he defaults, right? And that starts to happen little by little by little by little, and pretty soon that thing spirals out of control.
Cool. So let's take a step back, because you just did ton of information in
Oh,
like
sorry.
3 minutes. That was like a record. But you hit on amazing points, right?
Okay.
So the first thing is, when you look at a mortgage, right? What do most individuals look at when they think of, okay, here's a mortgage, right? It's a loan that's given by a bank to an individual to purchase a home, right? And they purchase the home, and then they make payments on that mortgage, right? Now most mortgages are 30 years long. Okay. Now, 30 years, long time.
Yeah.
Okay. It's a really long time. Do most people stay in their home for 30 years? And definitely not these days. Right. I think the average is like four to five years. Right. So that's kind of where everything ends for most people, right? That the bank gives them a loan, they pay the bank.
Right.
But do banks ever house those loans, right? Are they the ones that are lending their money to do it? Okay.
Right.
And that's where it kind of gets a lot more complex, right? Because initially, do they use their own money? For sure. Okay. But then they have an investment bank that will buy it from them. Now they'll still service it, like Bank of America or Wells Fargo or Chase. They will still collect the payments, and then they'll take that payment and then pay the investor, the investment bank. Right. But typically what happens is that investment bank will purchase the mortgage from them and then add it to basically a huge mortgage of mortgages, right? A huge loan or a huge security of mortgages, which could be thousands and thousands and thousands of them, right? And that's called, collateralized mortgage obligation, collateralized debt obligation. So those are, these big package securities. Now, who are buying these big kind of loans upon loans upon loans? Okay. You have, as you said, mutual funds, pension funds are buying them. Now, why are they buying them? It's kind of the idea of derivative, because the theory was that, if you have thousands and thousands of mortgages, okay, within one mortgage or one, big security, if one person defaults, it's not really going to matter, right? 2 people default, not really going to matter. 3 people, 4 people, who cares, right? So the more you have in there, the stronger the security is, right? All right, so that's kind of the idea behind, going from stage 1, which is between a consumer and a bank. Stage 2 goes from the bank to the investment bank, and then stage 3 is from the investment bank to a pension fund, or a mutual fund, right, or type of fund. And so that's what's interesting, is who usually owns, or who usually is the owner or the investor in mutual funds and these pension funds, right? It's the same person who takes out the mortgage.
Yeah, exactly.
It kind of it all comes home to roost, and it's like, and who gets fleeced in the end, right?
Yeah.
It's the consumer, because they get killed on the loan side of things. Yeah. Right, and then they get killed on the investment side of things, and then who makes all the money in between?
It's
fascinating, right? So these days you kind of look at, you look at the mortgage industry, and right now we are at like record low home ownership, right? So who owns the homes, right? And that is a great question. That's a topic for another day, right? But if you look at the home ownership rates, somebody owns the homes. So investors, right, like a real estate investor may own some. But here's what's fascinating, is there are these huge hedge funds and private equity funds that own just hundreds and hundreds and thousands, millions of homes. And now you have international investors like China and Japan, India, that are buying tons of homes in the U.S.
Interesting.
Fascinating, right? So anyway, it's kind of like the American public, right, got kicked out of their house, okay? And because, obviously the economy tanked, their job was put in jeopardy. They didn't have a paycheck, and so they had to default on their mortgage, right? And they, because obviously food was more important than that, right? And then, most people don't have any savings, so they were kind of forced out of their homes and forced to go, live in an apartment, right? Or live in like a mother-in-law apartment. I remember during the 2008, 2009, I had rented out one of our units, which is like the first place that Cynthia and I lived when we were married. It's like this basement apartment of a duplex, and it's like kind of dungy, and there's hardwood floors on the top unit, and so there's like you can hear everything. It's crazy. But you had this family of 5, right? They got kicked out of their house, lost their job, and moved into this tiny apartment, right, to make things work for the time being. So anyway, my point is, it's like everybody's got kicked out, and now who owns all the homes? Right? Who owns all the homes are the people that really got bailed out through this whole process, which are banks, investment banks,
Right.
pension funds, and so forth. It's crazy kind of how it comes full circle.
Full circle.
And who in the end pays the price, unfortunately.
Yeah, it's the people who were kicked out. It's the American public.
All right. So now, you look at the potential for mortgage defaults, right? I would say right now the potential for mortgage defaults is relatively low.
Right.
Okay. Now, looking at 2008, it was far enough in the past that those that filed bankruptcy, those that went into foreclosure, can now qualify, right? So you may have an increased amount of demand. Okay. But really looking at the potential default on a large scale, it's probably pretty slim.
Right.
But let's rewind to 2007. Okay. So the mortgage crisis didn't really start in 2007, right? At the end of 2007, there's some of the big investment banks who are doing tons of subprime started to fall.
Right.
I think like New Century was in there, American Home Mortgage was in there.
Countrywide, I think, was in there.
Countrywide happened a little bit later, right, in 2008, 2009. But the event in 2007 that most people are unaware of, it was kind of masked by the whole mortgage crisis, was the automobile loan industry. So if you remember in like 2007, oil prices shot up, right? And gas went to like over $4 a barrel or a gallon, and the value of SUVs plummeted. The default rates on SUV loans were like in the toilet. It was crazy. Okay, and that you look at that and like, okay, well, why would that spark like a some sort of a decline, right? Or market corrections? Well, it's because most automobile loans are positioned the same way as mortgages. Right? So again, going from bank to consumer, first phase, okay, bank to investment bank is the second phase. Okay, so looking at a bank like a Chase or Wells Fargo, they will basically purchase, okay, or they'll initiate or originate the loan, then they will sell it to these same kind of conglomerates. Is that fascinating?
It's crazy.
And there's a ton of subprime as well. So right now there is this massive bubble in a couple of different credit places, which is one, student loans. Number two is is automobile loans. All right. So right now I think it's of all of them. And we'll source this. We'll source this on the show notes. But right now, there's about $1.2 trillion of automobile loans.
Wow,
okay,
that's crazy.
And the percentage of those loans that are subprime is almost 25%.
Wow.
Now, subprime is when I have a credit score of 600 or less, and the interest rate is over 10%.
Wow.
Okay, so let's do some math on that, right? What is, if you really look at like the depreciation of a car, cars depreciate pretty fast. It depends on the car, right?
Yeah, sure.
Right, but over the course of like, let's say 5 years, right? What is a car depreciating by? 10 to 15%.
Sure.
Okay, loan interest is at 10%. So really when it comes down to it, over the course of this like 5 years, 6 years, 7 year period of time, when somebody owns a car, right, they get hosed.
Yeah.
Right. And who is perpetuating this and how is it going to end? So there's a lot of kind of conjecture out there as far as, what's going to happen. But if you really look at the increase in defaults, that is what's going to most likely trigger in markets, okay, some sort of a correction. Okay, so let's go to the Big Short. So in the Big Short, right, what started to cause the chaos, okay, in the mortgage market? Okay, because remember, in the Big Short, the main characters, what were they doing?
They were essentially buying insurance against the default of these CDOs. I mean, they were essentially betting on the fact that they would eventually fail.
Yep.
And the investment banks on the other side were, in the beginning especially, more than happy to sell them these, in effect, insurance policies, right? Because they didn't see necessarily the writing on the wall. They didn't see those things starting to default. So these main characters started to kind of see, the smoke trickling up. When there's smoke, there's fire. And so they started buying up massive amounts.
And that's the logical thing, dude. It's like, okay, if you have like thousands and thousands of these things packaged, it's like, well, more home values are always going to go up. They always have, right? And a bunch of people defaulting at the same time.
Yeah.
Right. So that's where, a lot of these investment banks just were not seeing the writing on the wall, okay, of the lax underwriting standards of the actual mortgages that were being put into their securities.
Right.
So going, you hit on something. I just want to make sure that we, talk elementary about it.
Sure.
Which is you had these insurance policies. Get these guys, the main characters of this movie and book they were real life. I mean, they're real life guys.
Yeah.
But they created those.
Right.
Okay. So if you remember, they went to the Goldman Sachs, they went to the Merrill Lynches, they went to all the places that had these, CDOs, CMOs, ABSs, the, asset-backed securities. They had these instruments. So basically they said, we want to do an agreement with you, okay, that says we will pay you, okay, for this agreement, this insurance policy. This is a premium, okay, and you pay us, okay, if the default rate is at a certain percent of this security, right? So if you had a security that was, $100 billion, right? Then if the default rate hit like 15%, I don't remember what the percentages were. Do you remember? No, I think it was like in the 10 to 20% range. Right. We'll have to verify that. But when it hits that default percentage, it will trigger the insurance policy, right? It'll trigger the payout, right? So they're paying premium upon premium. And they were paying like, hundreds of millions of dollars, billions in these derivatives, right? These insurance policies, right? But the payoffs were like massive. They're like 10 times. It was huge. So if you it was, I was going to use the Donald Trump huge again, but I think that's totally warranted its welcome.
Yeah, right.
But looking at, when that started to trigger, it was that asset that started to affect the financial statements of these investment firms, right?
Right.
Because if they have an insurance policy, they just can't like keep it in a drawer. They have to put on the,
That's
so looking at, what they were now on the hook for, given these default rates, that is one of the things that totally spiraled the mortgage market out of control.
Right.
So what would you guess is happening right now, right, with ABSs, asset-backed securities, CDOs that have, student loans, that have mortgages, that what's happening?
I'm guessing, subprime car loans are the new subprime mortgage.
Yeah. And you have these investment guys that are creating the insurance policies against it.
Right.
Okay, and that is what's scary. Because what caused it before was that, but what's causing it now, right? It's these derivatives, right? They're going to be out there. So what I would say is, from an investment standpoint, most people are like, well, I don't give a crap. I buy cars cash and I do. Yeah. Okay, I get it. It doesn't matter whether you have an automobile loan or not. This affects you because if you own a mutual fund, right? If you own, if you're part of a pension, right? So I was in Nashville this past week, and one of the guys, Seth, that runs the group that I was with, he sent out an announcement the night before, and they're in the music industry, and there's kind of like there's different guilds and there's different groups there, and unions or whatever for musicians, and they have a pension fund. Okay, so basically they received a letter, and that letter basically said that the music pension fund is not going to be able to pay its obligations past 2019 or 2019. Wow, crazy, dude. Yeah. And that's just this tiny little pension, right? Yeah. But there are tons of pensions that own this crap.
Well, and I can't remember the name of the documentary. Matt Damon narrated it.
Inside Job.
Yeah. I mean, there was a pension, I think it was in the state of Alabama, that essentially became insolvent because of what was happening with the housing crisis and the meltdown of the market. Yep. And how much easier is it to get a car loan? How much easier? How many more of these are there going to be packaged? Versus home loans. How much more common is a car loan versus a home loan? I mean, it just seems like this has the potential to spill over in so many different ways.
For sure.
And this could even be potentially worse, more devastating. And
that's the thing. It's crazy. And again, I in the beginning, the point was, it's like, okay, from the person at the low, the consumer, right? Yeah. Us at the street level. Okay, how are we affected? We're affected three ways. Okay, we're affected because number one, we can get fleeced with the wrong mortgage, right? Or a bad car deal, which we'll talk about in part 2 of the podcast. But the second thing is, we are most people's investments, their pensions, okay, their 401k, their retirement accounts are affected by it too. Whether they have a car loan or not. Okay, then in the end, who essentially comes to the rescue of all these groups?
The government.
Okay, government. Yeah. And who is the government funded by?
All of us.
Taxpayers.
Yep.
So 3 ways we're posed. All right. So looking at the issue at hand right now, be cautious. Okay, be aware of what's going on. Just I would start to maybe put in your Google alerts or whatever, just CDO or ABS defaults, okay, or something to that degree, because the writing's on the wall with student loans. Okay, but the issue with student loans is, because there's CDO, there's derivative against those as well. The issue with student loans is that you can, essentially, you can't bankrupt out of them. Okay, right. Car loans you can. Yeah. Okay, but the other thing with car loans, which is fascinating, is car loans have recourse. Okay, and what that means is every state has recourse laws, debt recourse laws. You can look at what your state is. It's for mortgages, and it's also for other loans. So basically what that means is, let's say that you buy a $25,000 car, okay, and you're going good, and you default on it, and it gets repossessed. Okay, let's say it gets repossessed, and you owe $23,000 on it. They sell it at auction for $10,000. Okay, that difference is $13,000. So what happens with that? Okay, banks can actually come after you personally for the deficiency. You know that because you were in the freaking industry. You were an attorney, represented the shysters that are actually doing that.
I was the one who was.
You were going and suing people. Yeah. So Utah laws, isn't it like 90 days in Utah where they have 90 days to serve you? If they don't do it within the 90 days, then there's no recourse, right? Something like that.
Generally, that's kind of the way. Yeah, that's the way it works. Way it works in Utah. It's called a deficiency action. In other words,
deficiency judgment.
Deficiency judgment. Yep. Yeah, it works kind of the same in the mortgage industry as it does in the car loan. Sure. But people think kind of there was a short sale, or lost it at foreclosure, or the car was repoed and sold, and then all of a sudden they're shocked to get
a bill
or a new complaint filing suit against them for
here's the deal,
deficiency.
Is I think they give them you get a 1099, right? They give you a 1099, then they sue you. So all right, so there's 4 ways you get screwed. 4 ways you get screwed. That's right. And in the end, it's insane.
It's crazy.
All right. Yep. So, you definitely look at the recourse laws in your state, because mortgage recourse, there's some states where it's like 10, the statute of limitations is like 10 years, 15 years, which means that, if you lose a house to foreclosure, right, and you don't file bankruptcy, then the deficiency between what they sell that at auction for and what you owed, they can come after you for 10 years. Oh, yeah. There's some states where there is no recourse, okay, where where banks can't do it at all. Okay, I think Texas is one, Arizona is one. I mean, there's a number of states that fit that criteria. But look at what your state is. That's hugely important.
And maybe one other quick point, too, just along the same lines of kind of getting fleeced, in these types of situations. There are most of my clients were credit unions, right? And credit unions are a little unique, and credit unions are popular. A lot of people have accounts, loans, and things with credit unions because their rates tend to be a little bit better. Savings accounts, those types of things tend to pay just a little bit better in terms of their interest rates. There's a unique structure, if you will, with credit unions, and that is, and again, just because I'm an attorney, don't take any of this as legal advice. I got to give that disclaimer. But
I thought you were an attorney.
I am, but don't interpret this as being legal advice or creating an attorney-client privilege. If you have a car loan with a credit union, and you also have a bank account with a credit union, or a credit card with a credit union, and you default on one of those accounts, let's say the car, they can pull your checking account balance.
Well, the thing is, even with a deficiency judgment, right? If they get if you are foreclosed on and you get a deficiency judgment because you're in a recourse state, okay, then now they get a judgment. If they find your bank, all they have to do is serve that judgment to the bank, and then they can garnish your account, right? And wages.
This is you can execute on a judgment in a lot of different ways. This is even before
the judgment?
Get to judgment.
Wow.
You don't have to have a judgment.
Wow.
It's called cross-collateralization.
Got it.
You could Google that term. Basically what it means is that car acts as collateral not only for the loan that you took, but it acts as collateral against the credit card that you have. If you have a personal loan that's unsecured, not so fast. The car loan collateralizes all of it.
Wow.
So if you've got money positioned in a savings account, the kid's college fund sitting in a savings account with the same credit union, and you default, the kid's college balance just got applied to that loan.
Wow.
So if you bank with a credit union, tends to be a good idea to maybe split up the car loan from the bank account.
So debt from asset.
Yeah. So
liability from asset.
They don't even need a judgment to get that.
That's incredible.
Yeah, a lot of things that can be done, and a lot of ways to get fleeced. That's for sure.
Sweet. Those zombie banks, zombie finance people, zombie attorneys.
Yeah.
I'm just kidding.
Sorry.
Man. I'm glad you came. I'm glad you left the dark side.
That's right.
Okay, so let's transition. But before we do that, I'm going to give a quick shout out to our free e-learning program. It's called Infinite 101. A lot of what we do here is education. Okay, I would say the majority of what we do. And we found a number of years ago that educating online, it's very easy, very simple, and very effective. Self-education these days is growing by leaps and bounds. Okay, sites like Coursera or Udemy or Khan Academy have really revolutionized education. So we kind of got on that bandwagon, create a lot of financial education on our free e-learning programs. Okay, so you can go to paradigmlife.net and access our free e-learning program, which is called Infinite 101. Also, we have a free real estate course. And so if you are interested in that, you can contact us at info@paradigmlife.net. Okay, well, let's go to the second part of this just stimulating topic that we're talking about today, which is effectively car buying.
Yeah.
Okay. So here's the deal. I'm gonna hit on one more thing when it comes to the who gets really hosed in the end. Okay.
Yeah.
And that is, if you look at what happened to home prices, okay, 2008, 2009, 2010, they tanked. Okay. So the reason why they tanked is because people defaulted and then banks were forced to sell. And obviously if you're selling and you have fewer buyers than you have more sellers than buyers, okay, prices are going to tank. And they, in some states there wasn't that much of an impact. Other states there were massive impacts, right? Arizona, Las Vegas, South Florida got hit really bad, right? And parts of California. So I would say, looking at that, it's an indication that when there is default, you're going to have price declines of the underlying asset. So looking at car loans, in the end, if you own your car free and clear, right? If you don't have a loan, if you have amazing credit and a small loan on it, okay, this whole charade affects you too.
Yeah.
Okay, and it affects you because if prices across the board decline, your car value declines, right? So if you have this big the tidal wave of defaults and the underlying security tanks, okay, it is going to affect jobs. It's going to affect business. It's going to affect other industries, which means less wages, and then less wages means you can't pay as much for your debt obligations, and it creates defaults. Anyway, the point is, when all of this kind of comes home to roost, you're going to have massive price declines. Yeah. And when those price declines happen, it's going to affect you whether you have a loan against your car or not.
Right.
All right, cool. Just making sure that we covered that point.
Clear. Yep.
All right. So is there a way to make money on a car? When you buy a car, because most people look at a car and they're like, it is a depreciating asset.
Right.
It's a waste. And I would say it depends on your perspective. Okay, it depends on what you use it for. So if you look at a car, the justification of a car is, does it lose value? For sure. It gets appreciated. There's always another model coming out, which makes yours less desirable. So you have that dynamic going on. But in the end, what's the alternative? Okay, and the alternative is you walk, or you ride a bike, or you take public transit. Yeah. But I would say that in our day and age, the alternative is becoming much more attractive.
Yeah.
Okay. Taking Uber, doing public transit, riding your bike, or even walking or carpooling. It's becoming more popular. So I would say, the first thing really when a person, and this is going to be discussed in the ebook that we have coming out, but the first thing is to really identify what the need is. Like, what are you using it for? And is there an alternative? Okay. So that's the first thing. But the second thing is, let's kind of go through some of the mechanics. And since you're in the market to buy a car, maybe talk about what you are doing, because you are financially astute. Of course. And you know that banks screw people because you represented the banks that were screwing people.
Yes.
So what maybe before I get into some of the things that I prepared for, what do you see as your due diligence process? Because I know you super detailed, super educated, super knowledgeable. What are you doing to make sure that not only you get a good car deal, but that you make money on a car?
Yeah, and to
on the car buying.
Protect myself. So, again, it depends on person and objective and all that kind of thing. But I've never driven a brand new car off of the lot with 0 miles. Right?
Why not?
Again, yeah, I think there are some ways that you can kind of make it work, but generally speaking, the greatest appreciation happens in the second that car is driven off the lot and it starts to hit 10, 20, maybe 30,000 miles. Mm-hmm. That's the most significant decline in terms of that car's value. Okay. Depending on the car, some depreciate quicker than others. Typically luxury vehicles, BMWs, Mercedes, etc. You may pay 50, 60 grand brand new, but within a couple of years, maybe it sells for 40, right? So there's a pretty steep decline when it comes to that.
So I heard, to rebut your point, I heard if you buy a Ferrari, like a brand new Ferrari, right, and then you sell it the next year, you'll be able to sell it for like 1 or 2% less than what you bought it for.
Wow.
Okay, so you can own a Ferrari.
Yeah,
so and just go buy a Ferrari.
I haven't priced out Ferraris.
I can see you like stuffing all your kids and wife in the Ferrari.
Yeah. Well, my wife's only request, because she knows I'm shopping around too, and she's just like, I don't want anything too flashy. Okay. Somehow I think the Ferrari would fail the flashiness test.
Probably. You can always put you put a skin over it that will make it look like a Corolla or something.
Like a Kia or something. Yeah, you probably could.
No, that's the other way around. When people create those like Ferrari kits and they put it over the engine of a Corolla.
Oh,
those ones. Okay. All right. Sorry.
Go ahead. I was going to say, and to even maybe rebut my own point, right? My brother-in-law he and I have been talking cars for the past couple of months. He pulls into my driveway last night with a brand new, it had 30 miles on it, and probably 15 of those 30 were him driving to my house from the dealership, right? It was just a sweet white Chevy, like 1-ton dually truck. So he's got horses and he pulls a trailer and he does all this stuff. Basically brand new, right? It's a 2016. This is the time of the year where they start to roll out 17s. Mm-hmm. So he said with manufacturer rebates, dealer rebates, I think he said it was $12,000 to $14,000 off MSRP, right?
Wow.
That's not going to be a commuter vehicle. He's not going to put tons of miles on it. In other words, we had this same discussion. He's like, I could drive this as much as I'm planning to drive it, and in 2 years probably sell it to a third party for what I paid for it.
Sweet.
Today, right?
That's amazing.
That's having had the benefit of driving it, using it, et cetera, et cetera. So those types of situations, again, depending on the time of the year, depending on, if it's the model that's being pushed out because a new one's coming in. Another instance where this can be hugely beneficial is if you're buying a car where, let's say it's the 2016 and the 2017 is a new body style. So the manufacturer wants those 16s gone so that they can push the 17. They're going to cram that thing full of incentives and rewards.
Okay, so timing is huge.
Timing is huge. Okay. Especially with brand new. Timing is huge with brand new.
All right, so let's talk then. Let's reverse it. Okay. And since you already know what you're doing, right, you're going to probably do a ton of research.
Yeah.
You know exactly what you're going to buy. You're going to know what your trade-in values are. You're going to know all that stuff.
Yep.
Let's talk about the common mistakes people are usually making with their car buying, because most people are not doing that necessarily.
Right. And I've got one. I've got one right out of the chute. So
cool.
I'm I kind of started with this idea of, if you look at a luxury brand that's a couple of years old and you see a massive depreciation, particularly in those brands, other than Ferrari, right? In that first couple of year period, that's kind of the wheelhouse that I'm looking at. So I'm looking, BMW-ish, right? Couple of years old, fewer than 50,000 miles. So you can still kind of capture a little bit of the warranty. You can maybe add an extended warranty to it, but you can kind of take advantage of some of that depreciation in that first couple of years. Let somebody else deal with the fact that their vehicle that they bought brand new has depreciated, and then I'll pick it up for roughly the equivalent of what you could buy a nicely equipped Accord or Camry or something like that, because those don't depreciate as quick.
Much. Yep.
The risk, though, is when you start to shop around and you see a lot of these, car dealerships that maybe, they're advertising these vehicles. For instance, I have a good friend of mine, a guy I know well, has a used car lot. He picks up a lot of these luxury brands
at auction,
right? So luxury vehicles that were leased, right, for a couple of years, and now they're coming up at the end of that lease, and the manufacturer is auctioning them off to these car buyers, right?
Because they need to clear inventory for all the new stuff.
Yeah, they've got to clear inventory. Yep. They're not in the business of selling tons of used cars. They want the new stuff.
Yep.
So a guy like my friend, he goes to, Vegas, LA, Chicago, Atlanta, Phoenix. These are kind of locations that are commonly known as these big auction sites. He goes in, he buys his inventory, then he brings them back and he sells them at his lot, right? He picks them up at auction. But of course, not all of those cars that are being auctioned off are created equal. They're in varying levels of condition, right?
And mileage.
Yep. Right? And so I've got him looking for me, right? He knows kind of the wheelhouse that I'm in, years, mileage, et cetera, good condition. Well, as it turned out, today is actually the day of the Vegas auction. And last night, he gets the list of the vehicles that'll be there. There aren't any in terms of what I'm looking for, the year, the mileage, all of that. There aren't any, right? So I just sort of out of curiosity, I start looking around online. I find exactly what I'm looking for at another dealership, kind of a competitor of his. And I said, well, tell me about this one. I send him the link. I text it to him. Tell me about this one. What's the deal here? It looks like good price. Year is right there. Mileage is right there. What's the deal with this one? He texts me the Carfax report, right? You looking at the listing online, it looks great. Yeah. I'd see no issues with it. He sends me the Carfax report. It's been involved in 2 accidents.
Ooh, okay.
Okay, so it hadn't ever been totaled, so it wasn't a branded title or anything like that. Typically, dealers will say, oh, branded title, clean title.
Yep.
But there's a whole spectrum in between that, that maybe it's not technically branded, but it's not technically clean either, right? So then he sent me, so it was priced at whatever it was priced at. Based on the Carfax report, the Carfax was showing the value as being about $6,000 less than that dealer was selling it for. And so I called him and said, dude, what's the deal? How can they get away with that? And he's like, I actually kind of know them. You cross paths at auctions. And he's like, I buy my stuff in the first hour to 2 hours of the auction, the stuff that's clean, the stuff that's good.
They buy the second half?
They buy the second half. They're the ones staying there all 4 hours, and they're buying at the end. Yep. And he said, I asked him about it. And their response was, if somebody asks, if they say flat out, has it been in an accident? I'll, of course, tell them. But if they don't ask, and if they don't run the Carfax themselves, I'm not going to say it. Why would I draw attention to that?
That's crazy.
It's like, I'm going to sell it for what I can sell it for, and it's kind of buyer beware. So that was last night, literally, that I had that conversation.
And this is all,
it's crazy.
And this is all, again, this is, I would say the biggest thing that separates a person from making money with this transaction, which everybody takes part in, and the person that loses money, is their level of education.
Right.
Because oftentimes I would say that when a person walks away buying a car, they don't know whether they've lost or won.
Sure.
Right? And I think for the most part, it's because of the education level.
Yeah.
So education, what would you say are some of the ways in which a person can become educated about the different aspects of buying a car? Yeah.
So, I would say, this day and age, especially with all the resources that exist online, there are so many websites, NADA, Edmunds, Kelley Blue Book. I think once you kind of know what you're looking for in terms of the type of vehicle, the year, the mileage, you need to know what the fair market value of that vehicle is, at least what the range is.
But you can find the two main values, MSRP, which is retail.
Right.
Okay.
And private party.
And then private party, but you can also know what dealer price is.
Yeah.
Okay.
Yeah.
And there's a lot of ways in which you can find out what the dealer price is. So now you see kind of like what the difference between what they're selling it for and what they bought it for is.
Yeah.
Okay. So that's the first thing.
It's huge.
Okay. Second thing I would say is, really knowing what you need, right? And what your budget is. So how are you figuring out what you need and what your budget is?
Yeah. So, need obviously is a relevant term. Need, I think a lot of times we confuse need with want, and I think it's
luxuries become necessities.
More towards want. Yeah, so I think for me, it's kind of taking a step back and saying, what's the purpose of this vehicle going to be? Is this my family vehicle? Are we driving it as a family? Or in my case, this is more or less
Your commuter.
Right? I could put a couple of kids in the back seat if I had to, but by and large, this is me driving it every day. I usually run a rough calculation of how many miles I drive per year, and I kind of factor that into, okay, how quickly is this vehicle going to age? How quickly is it going to come up upon, maintenance and repairs, and what's it going to cost to perform those? I like to build in a lot of kind of estimates when it comes to that, so that I know, and that's another term that I think is helpful for people to know, and that is cost of ownership. So you can go to different websites and you can calculate what the cost of ownership is with respect to a particular vehicle. So you can say, well, is a Honda Accord more expensive to own in terms of cost of ownership versus a Mercedes or a Volkswagen Jetta, or wherever the case might be, and they'll calculate when maintenance is likely to be necessary and what the cost is associated with that maintenance. And you can then say it's cheaper to own this versus that.
Okay. So all of this, again, is done in advance of doing it. This is all due diligence. This is all research. Okay.
You don't want to be the guy you don't want to be the guy that you get distracted by that picture online and that sounds like a fair price and you go in and buy it, and then you discover after the fact, when you take that vehicle for maintenance or something, and they say, oh, by the way, did you know that the frame is bent, right? And that vehicle that you picked up for $30,000 is only worth $25,000. That's got to be a really frustrating thing.
Okay, so what else? So what else can you? Because we have a few minutes left, then we'll end this thing. So I would say, the biggest thing is research, right? Knowing what you're buying, knowing what pricing is. Okay, but then the second thing is the financing, and then we'll do the third thing as the dealerships. Okay, so financing. So the cost of ownership, a lot of it sometimes has to do with the financing aspect. Okay, now there are traditionally about 3 ways in which you can purchase a car. You can purchase it cash, okay, or with your own finance, or with your own financing that you qualify for up front.
Right.
Okay. The second thing is the dealer financing, okay, provided by the manufacturer, and then the third thing is a lease.
Right.
Okay. So if you look at those 3 ways, okay, is it going to be the same? You don't know. So again, you talked about the cost of ownership. We did, we basically built a calculator they'll go along with the ebook that basically will show, okay, here's the price for cash and private financing. Here's the total cost associated with dealer financing and their incentives, and then here's the cost associated with leasing, and it'll show you kind of what the cost of ownership is going to be, respective of all those options, and show you which one in the end will be the best bet for you. Okay, and that really comes down to how this last part, which is how you are treated when you show up to the actual dealership itself. Now, these guys have, obviously a stigma, a stereotype associated with who they are and what they try to do, and rightfully so.
Yeah.
Okay. They, are guys that, they want to sell stuff, right? And they are professionally trained to do so. So when they come on, they have everything from like how the dealer floor is positioned to how they're dressed to, the position of their desk to the lighting. Everything is designed, right, to put you in this framework of buying.
It's like a Vegas casino, with how things are. Yeah,
it is. It's positioned very strategically, right? And in the end, understanding that interaction and what is typically going to take place. Okay, you can do some due diligence online to understand that, because if you start to get swayed and don't know what they're going to be saying or why they're saying it, then you're going to succumb to their tractor beam.
Oh yeah.
Okay, so that's the other thing, and I think looking at really where most people get hoses is in that type of transaction.
Right.
Okay, and then the final thing I would say kind of goes along with the pricing side of things is the price of the car versus the payment.
Yep.
Okay, so let's talk about that. Right, payment is obviously very, very important, but really when it comes to how these guys kind of push their vehicle and push the options and so forth is based on the payment, not the price.
Right.
Okay, and that is, I think, where people get really hosed.
Yeah, no, and just to maybe speak on that, I have a couple of good friends in the car industry, and I remember one time having a discussion. There were a few of us kind of mingling around talking about cars, and a good friend of mine was just sort of talking out loud about how he needed a car, and the guy who was in the industry said, "Well, what payment are you comfortable with?" In other words, it doesn't matter what you can take this massive car purchase, and depending on how long you want to spread it out and different things that you want to do, you'll cram it into a certain payment
to be able to get the highest price.
Yep, exactly. And so those are the terms that they speak in, and that's what do you want your monthly payment to be, not what do you want the purchase price to be.
Cool. All right. Well, we are pretty much out of time, but this is good. I appreciate you. This is a good discussion. Very, very timely that you were in the market. But this is a purchase, that everybody makes, right?
Yeah.
And I think the perspective that we try to have and what we teach clients is to look at every transaction where you're benefiting from every transaction, including transactions like a car transaction.
Right.
Okay. And there are many ways to do that. A lot of it comes from saving as opposed to paying more than what you should.
Right.
Okay. But also looking at the fact that cars are one of those things where there's alternatives, and it may make sense in certain circumstances to not get one. There may make sense to get this type of vehicle versus another type of vehicle. So really looking at transactions and being efficient and productive with your money in the long run, it's huge.
It's huge.
So looking at what we calculated, for those that really don't understand the game, okay, there is essentially throughout your entire lifetime millions of dollars that the average person is going to lose, right? Because you factor in what they're going to pay, then you factor in opportunity cost, right? Then and then also credit into the mix.
Yeah.
It spirals you out of control. So it accounts into the millions, and that'll be part of the calculation we'll show in the ebook. But anyway, look for that in the next couple of months. But we'll go ahead and end. Thanks everybody for listening this week. Hope you got some stuff out of this. Hopefully you go out and you make some money buying a car. All right, that's it for now. We'll talk to you next week.
You've been listening to the Wealth Standard Radio Show, your gold standard in everything financial.